All right. Hello, everybody. Welcome to our webinar for today. First of all, thank you for joining us, and good morning and good afternoon. Today, we're going to spend some time looking back at 2023 and then also giving you an outlook for what we think will happen next year. My name is Zeid Houssami. I lead global air freight for Flexport. I've been with the company for a little over 3 years, been in the industry for a little over 20 years. Before we jump in, just want to cover a few housekeeping items. So on your screen, you will see a sidebar to the right of the main stage. We're going to use that to interact with the audience. So if you need any help at all during the webinar, just drop us a note in the chat and we will do our best to help you. We're also going to leave about 20 minutes at the end of the session to walk through some Q&A. So there is a question and answer tab in the sidebar. So just feel free to drop in your questions there sort of as they come up. And then at the end of the presentation, we will try to get through every question. So try to get your questions in as early as possible. Last but not least, we will have this deck available to everybody. We'll drop a link in the chat to you here. And then you can also expect to see an email follow-up with a link to the deck. Just one quick legal disclaimer. Let's jump to the next slide. So just a quick legal note here. Just keep in mind that the information provided in this session is based on the current market situation at the time and may not be customized to your specific business requirements. We always recommend that you speak with your local Flexport expert to discuss your particular situation. All right, so now that we've gotten that fun stuff out of the way, let's jump into the agenda. So there's a lot going on in the market, obviously. I think like any year, 23 was a bit of a roller coaster. So we're going to spend some time looking back at what happened this year. Just to give you some insights, which will help us provide an outlook for 24. We're going to talk through 4 key drivers for 2024. Should be a year of more stability, which I think everybody's really looking forward to. And then finally, we'll spend some time going through our outlook, followed by a Q&A session. So with that, I'm going to turn it over to my colleague, Thomas, to kick us off. Thanks, Thomas.
Yeah. Hey, Zeid. Good morning, everyone. Very glad to have everyone here. Thanks a lot for joining us today as we look back to 2023 briefly, and then of course the more interesting part, as Zeid already mentioned, gonna give our best outlook for 2024. Next slide. As we recap the year in terms of the 3 dimensions of capacity, demand, and recovery. So basically on the capacity, we are almost, in brackets, fully back to capacity in some regions already, or even surpassing capacity levels. And Asia basically being the big storyline in terms of capacity this year. Of all the capacity that came back on the market, Asia by itself accounted for 40% of that overall capacity growth. We've seen in the past 4 weeks there we have seen a rise of around 2% of capacity. So that's an upwards trend still ongoing. And particularly the freighter capacity increasing. And there, of course, very much visible, and we feel it all, the China to US routes, they are a surge of 18% due to the high demand, and we'll come to that also later on in more detail. On the demand recovery side, well, in 2023, we have seen that demand gap year on year, and that's what you see in the slide deck. When you download it, you will see it in better detail, but basically you see that blue color, that's basically showing you the gap to the previous year. And we've seen that gradually in Q1, Q2, and Q3 decrease, and then in Q4 actually go into demand recovery mode, where we are now compared to October 2022 at 3% of an increase. And obviously that continuing as we all see on the market right now. The rates have stabilized this year. That's the effect that started in 2022 as we saw the global rates starting to decrease. We have actually seen that rebound, right? Just after the summer. Many of us kind of course, knew that this would happen, right? With the flighter schedules after the holiday season being reduced. But then what happened also is that the demand just spiked for some in the industry, even a bit unexpectedly, particularly the e-commerce and the consumer electronics that really have driven that and are continuing to drive that with Asian retailers, producers, and importers, all fighting for space here on the Trans-Pacific lanes. So basically, there that also showing us a bit what could happen in the future in terms of a normal seasonal rate levels and developments, and as Zeid mentioned, more stable waters, hopefully, as we go into 2024. Next slide, please. Where do we stand now compared to pre-pandemic levels, which kind of still serves, crazy that it took that long, but it still serves as the key indicator of, the last normal year versus what could be potentially something along those lines. I don't think anybody of us dares to use any of those words yet, but if we just take a quick peek back and compare ourselves to where we stand compared to 2019, on the supply side with 0%, so they are more or less on par levels, globally speaking. And they're not expecting much capacity to be added in the course of next year, except, and we'll come to that later, on the China to US side, if the diplomatic efforts that are currently ongoing will bear fruit. On the demand side, there with -8%, that's primarily driven by the general cargo. When we look at the specialized cargo, we can actually see that segment of specialized cargo growing at an annualized rate of around 3 to 4%, particularly driven by the domains of high-tech, valuables, and perishables. And then that big plus number that probably some of you are looking quite eagerly at is the 43% plus. That's the average rate levels compared to 2019. We have seen that gap, 2019 to today, increase steadily. Just a couple months ago, compared to pre-pandemic levels, we were at like the higher 20 percentage range. So now we're at 43%. Obviously, that giving also a bit of a trend of what we see, and we will come to that in a moment. Next slide, please. So now let's have a look at the major drivers. We identified, out of all the ones that, of course, you can look at, we try to minimize it to 4 to kind of keep the focus of conversation and kind of like make sure there's some clear takeaways for everyone. Obviously, there's many more than that, but let's jump to the first one, the first driver. So, of course, on one side, one has to look at the consumer spending and what impact global trade and what impact that will have on global trade. So overall, we will see global trade to grow in the 3 to 4% range. We have seen the consumer confidence actually increase for the first time in 4 months in November. We are definitely not yet in terms of consumer confidence, and that's the graph you see on the lower right of the screen right now. Definitely not yet at 2019 levels. We're more on the par with 2017 levels, and that was not a bad air freight year actually. So probably the hopes are up for that to give us a certain indicator, at least for the second half of 2024. Inflation had already peaked. We're past the point. It has actually now gradually decreased and will continue that decrease overall. For the Western world, when we look at China, it's a bit of a different story. China actually looks at a deflation, and one of the indicators to make such statement is the China's Producers Index, which actually has declined for 13 months straight. And what this index actually measures is the change in the price of goods sold by manufacturers, and therefore serves as a leading indicator of consumer price inflation, which accounts for the majority of that inflation, or deflation in this case. So deflation, basically, what does that mean? That is a signal for a stagnating economy, which is still something for China to look for, and worst case can also lead to a recession. Now, that's just being said in brackets in terms of like what actually deflation could mean if that further continues. Wrapping up here on the first driver, while the first half of 2024 is still expected to be stronger than obviously the 2023 one, all the market conditions and global conditions as well, are not expected to improve solidly until Q3. Next slide, please. So when we look at the driver number 2, basically capacity resurges with regional variations. There on the regional variation side, we have seen this year the transatlantic, of course, coming back stronger due to the openings of the markets earlier, just between January and September. We've seen the direct air cargo capacity increase there already of 12% year on year. So the transatlantic is not so much to look out for. It's really more Asia Pacific. Of course, there are two elements. One is the late opening, which we have already seen. And also, when you particularly look on the trade route between Asia to Europe, there you see certain conflicts happening, right, in the Middle East, the Ukraine-Russia conflicts. And those kind of things obviously will have a big impact on some of the capacity deployment. Just as an example, on that route from Southeast Asia to Europe, you add around 2 hours of flight time just because of the Ukraine-Russia conflict. And in the meantime, actually, what you have seen is while on that route, basic capacity was down compared to 2009 levels by 11%, via the Gulf, it actually increased because you've seen kind of like a leveling between what it takes to just transfer that cargo in the Middle East versus having a direct flight. So that kind of got neutralized that effect, which is interesting also to keep in mind that such conflicts, wherever they happen in the world, will have an impact on some of the airlines and operators behind those planes, how they basically plan and manage their networks. And of course, it's our job to monitor that, and also our customers, we keep them regularly updated on that. On the freighter to belly side, well, we have seen it already this year. It was a challenge for all cargo operators. We all know the names out there that are facing challenges right now. And unlike the combo carriers, as we could call them, right, airlines that are operating both passenger and cargo, the air cargo operators are very much reliant on their cargo network, right? And it's usually designed on the outbound to be very attractive for their customers. Usually the problem is the backhaul. And there, obviously, particularly when we look at the backhaul operations and the challenges these operators might face, potentially leading to reduced flights to manage that, and obviously then an increase in the rates, as the market in the past has shown that for all cargo operations the willingness to pay could be a bit higher. So these operators will try to manage with this element their situation in 2024. On the capacity outlook, well, there it's all about Asia. We have mentioned it before. We have seen already a neutralization there, recovery on the transatlantic. Of course, bits and pieces still coming back, but mostly we're going to see the eyes will be all on Asia, what's happening with the return of further capacity, particularly long-haul flights between Europe and Asia, from Europe to Asia, and also from North America to Asia, keeping in mind that we are currently at around 70 weekly passenger flights between the US and North America, and comparing that to pre-COVID levels of around 340. So if those restrictions will be rolled back, that of course is something that could happen towards the end of Q1, Q4, maybe, and obviously that will have a big impact on the Trans-Pacific capacity. Next slide. So we have prepared 2 poll questions, as Zeid already mentioned, just to get a bit also an impression of your thoughts on 2024. So I will be jumping to the first one. Basically, here it is in front of you, and again, as a reminder, you do have that poll mark to basically enter your answer. So when looking at your air freight procurement strategy for 2024, what rate validity periods are you planning on administering next year? Is it either going to be monthly? Right now we're trending towards that as far as the board here shows, more of a quarterly, semi-annually, not so much at all, or some who are very daring even annually. Yes, the results are coming in. I think we're more and more trending on a monthly basis, followed by a quarterly basis, and neglectable in the semi-annually.
And just one thing as well. So for those of you looking how to participate in the poll, there's a tab that says polls in the top right of your screen. You can just jump in there. Looks like the consensus is in. It looks like monthly is the way to go for next year.
That's right. We will jump to the next question, I think. Then,
All right, let's go to the next one. Thank you for your answers, everybody. Next question. So same thing. Use the poll feature in the top right. So the question is: considering the current market volatility, are you considering fixed capacity agreements on key trade lanes as part of your overall strategy? And so think of a fixed capacity agreement as a block space agreement between a shipper and a freight forwarder.
yeah.
Okay, this is about what I was expecting.
Yeah, more or less, indeed.
Okay, I think it's settled in there. Great.
Pretty clear.
Awesome. Okay, good segue to the next driver. So let's talk about contract dynamics. Carol, if you could just jump to the next slide. Thank you. I think first off, just to kind of preface this slide, I mean, I'll share some insights with you in terms of what we're seeing commercially. So I think just in general, when you look back to where the market was, almost 4 or 5 years ago, it was really primarily driven by heavy consumer electronics, NPI goods, more expensive, high value consumer electronics, right? That, of course, is still very prevalent in the market, but we've seen a shift in the profile over the last 2 or 3 years. With these e-commerce fast fashion companies, and so they're all leveraging Section 321, and really what they're using is commercial capacity solutions to compete against the likes of Amazon Prime's 2-day delivery service. And what these companies value is really speed and reliability. And because they're really aspiring to hit those aggressive SLAs for their consumers, they're also often willing to pay for those services, and they use more premium airline products. So think of companies like Shein or Temu or some of these large e-commerce brands, both China-based, European-based, and American-based. I mean, they're all consuming a ton of air freight capacity. And so what we've started to really see here is a shift towards longer-term contracts between the shipper and the freight forwarder, and oftentimes even the shipper trying to work directly with the airline, which is very unusual. Never seen anything like this before. And they're really doing this as a way to diversify their procurement strategy, right? It's not the sole lever that they're pulling, but it is one way that they're able to create more predictability, both in cost and speed, right? Especially as you go into to a heavy peak season like we've seen this year. So I think overall in 24, we'll continue to see a consolidation towards these longer term contracts. I think it's a good signal that there's just overall shipper confidence that the market will be more predictable and more consistent. Compared to years past, you saw huge fluctuations, week to week or even day to day during the height of the pandemic. I think that there's more trust, there's more confidence going into next year, and as a result, you'll see, and we saw that in the poll results too. I think there was maybe 25% total responded with either semi-annual or annual contracts. That's a really good signal that the market is starting to stabilize, and shippers have confidence that supply and demand are going to be more balanced going into next year. The next big topic is risk management, and I like to call this the pandemic PTSD. And so I think, really what happened when demand levels were surging and consumers were spending money on durable goods, a lot of the freight forwarders really overcorrected and signed long-term block space agreements in 21 and 22, and even leased their own aircrafts. Really overnight, in a matter of 3 months at the end of 22, the market normalized very quickly as soon as the economy started opening up and consumers could start spending money on services. We saw demand levels come down drastically. And so that created a market with excess capacity at the beginning of this year. And really, that's where we started to see rate levels start to deteriorate because there was a ton of debt freight out there that was being absorbed by really discounted rates to offset that fixed capacity. So I think what we'll see next year, and we'll talk about this in the market outlook, is a bit of more of a normalized, pre-pandemic market environment. During the pandemic, we saw about 70% procurement occur on the fixed market or BSA market, really to create that locked space. Last year, we saw that pendulum completely shift with almost an overcorrection of 30% fixed and 70% spot. And that's really what's created, I think, a lot of rate volatility this year. 24 should be much more normalized. And so we should anticipate a more normalized environment. And I think most forwarders will look to leverage a more stable procurement portfolio of about 50% fixed or BSA and 50% spot. So, as a risk mitigation strategy, forwarders are going to continue to balance both, and really doing that to offset some of these longer term selling strategies on the shipper side. The last thing I want to touch on as well here on this slide is the changes in the logistics partnerships. And again, there's a bit of a pandemic impact here that I think is kind of rolled over into this normalized market environment. And really what the pandemic did is that it forced the shipper community to build new relationships with freight forwarders. Because there was, a shortage of space, really most customers were looking for capacity and would really do anything that it took to get that space. And so that really introduced a lot of new relationships. I think there was also an acceleration of digital adoption during that pandemic period, which made it much easier for shippers to work with multiple freight forwarders. And so really during the height of the pandemic, you saw, shippers work with 10 plus freight forwarders just based upon space availability. And so what's happened now is we're back to more of a normalized market environment is, those relationships have sort of continued. But we're starting to see that normalize back, right? Where that there is overhead involved with managing 10 plus providers, right? It's difficult to manage 10 or more relationships and manage 10 or more rate agreements. There's quite a bit of overhead there, right? And we all know that logistics is not usually well budgeted. So what we're starting to see now is a bit more of a consolidation back to the traditional kind of relationship management strategy, based upon pre-pandemic levels, where shippers are looking to consolidate the number of providers, primarily due to the confidence level of the market in terms of supply and demand balance going into 2024. Okay, let's jump to the next slide. Yeah, the last driver is really related to this idea of driving sustainability, and really what we're seeing across the board, and almost every single customer that I speak with, has some sort of sustainability goal. Even if it's 10, 20 years out, I think every executive suite is talking about sustainability, and logistics is undoubtedly one of the primary drivers to improve that. So I think on one hand, you have a really concerted global effort to be more sustainable. There's tons of regulatory pressure. There's lots of corporate pressure as well. But there's still a reliance on air freight capacity. So it's almost like a bad habit. It's hard to break, once you've conditioned your customer base to receive goods so fast. And the benefits of just-in-time inventory are obviously huge. I think some great examples here. I think earlier last year we saw Amsterdam really impose flight reductions with Schiphol Airport, just based on sustainability goals that they had. And so that obviously has an impact on capacity and subsequently rate levels. So I think the truth is, though, when you take a step back and you look at what are the sustainability opportunities in global logistics, still 97% of volumes move on ocean freight. And I think from a GMV, gross merchandise value standpoint, it's probably a little bit lower than that. But I think nevertheless, there's still a much larger opportunity to drive sustainability initiatives on the ocean freight side. So the scope in air is a little limited. And air freight does continue to remain a vital service level for customers, especially on the humanitarian side. I think the irony of all of this is that a lot of the climate change issues that we're seeing on the news every day, whether it's droughts affecting the Panama Canal, which we saw last week, or some of the extreme weather situation that we saw in early November in Anchorage, all kind of driven through global warming, is ironically actually creating more demand for air freight. And so I think we just live in this conundrum of sustainability versus the need of air freight. So I think to wrap up this slide, we will continue to see shippers accelerate their sustainability initiatives. I think Europe is a little bit further ahead than North America. The options remain fairly thin, right? There's obviously a lot of carbon offset opportunities. Sustainable aviation fuel is still in really low supply. It's extremely cost prohibitive for most companies to budget for that and to earmark part of their logistics spend on SAF products. But I think over the next 4 or 5 years, as manufacturing scale improves with SAF products, you'll see those price points come down and become a little bit more palatable for most companies. Okay, let's close it out. So having said all this, what should you expect for 24? I think many of you are probably planning your budgets for 24. I think we've sort of teased out stability, on the horizon. And I think that really looking back at the last couple of years, really the pandemic was almost a forcing function in a sense that created resilience in supply chain. So let's jump into to 2024 and what we expect. All right, very good. So Thomas touched on some of the statistics that we project for next year. I think really looking at air freight demand, right in line with sort of GDP growth, really moderate growth in air freight demand. We'll continue to see supply start to get injected primarily out of Asia, specifically out of China, as passenger capacity starts to come back. And it's really going to be a chance for the market to catch their breath and really start to think a little bit more strategically about their supply chains. I touched on as well sort of the rise of longer term contracts between shippers and freight forwarders. I think when compared to the pandemic, rate agreements were weekly, almost daily in some cases. I think now we're seeing a shift back towards these semi-annual and annual rate levels. And I think from a forwarder perspective, that's also very much desired. I think it's a win-win for the entire industry. Sustainability, I touched on this in the previous slide. This is going to continue to exert pressure, whether it's corporate pressure, regulatory pressure across both modes, air and ocean. And then, there are always black swan events that occur, every year, right? Whether it's a crazy volcano in Iceland or, some sort of weather system. I think most recently it's the Panama Canal that we're experiencing, but, we'll continue to see, different black swan events. It's obviously very difficult to predict what those are. But I think, from an ocean freight market standpoint, we're seeing some of the impacts of the Panama Canal on air freight. So I think overall, expect a fairly stable 2024 with a more traditional peak season. Going into, January, we're expecting January to be fairly strong, sort of leading up into Chinese New Year as companies look to push out inventory before the market really sort of shuts down for a few weeks. And then we should pick back up again starting in March for quarter end, and then sort of re-enter a traditional kind of shipping season, really kicking off with peak in September. I think the last thing I'll leave you with before we jump into Q&A is just some other uncertain events that were it's hard to predict what will happen, but I think time will tell what the airline industry does with their freighters. And so there's a lot of old equipment out there, really 4-engine aircrafts. The last 747 freighter was shipped off of Boeing's line, I think about 6 months ago. That's the last one of those aircrafts. And so, you're starting to see some of the newer aircrafts, whether it's the 777 or the Airbus aircrafts, start to actually ship. And so these older aircrafts are very, very inefficient and they're very expensive. And with jet fuel being as high as it is, it's from a cost economic standpoint, these freighter operators won't be able to continue flying those aircrafts with jet fuel being so high. And so it almost creates a forcing function in a sense to accelerate those retirements. And we've seen, some of the impacts that's had on some of the smaller, more regional charter operators with some bankruptcies being announced this year. There's obviously geopolitical tension, very difficult to predict here, whether it's the Israeli-Palestinian conflict or the war in Ukraine. These have issues in terms of consumer confidence. There's impacts on oil and the impact that has on jet fuel. That's really a wild card and an unknown thing. So I think the last thing I'll leave you with is just, politically between the U.S. and China, kind of last wild card. It feels like the market's starting to open back up and the Chinese government's talking about adding more passenger capacity. Thomas touched on really the flight slots out of China are only used at a 25% clip. So pre-pandemic, we saw 350 plus flights from China to the US. Today, it's almost 75. So there's definitely some opportunity there to inject some capacity. So with that, I'm going to stop here, and we've got a few minutes left for questions. So we'll turn it over to Thomas to MC us.
Yes, thank you very much, Zeid. And thanks for the ones who have already thrown some questions in. As a reminder, on your right side, you will have a tab, Q&A, and that's where you will be able to enter the questions. Basically, we see so far a couple here. They all have equal votes, so I'm just going to pick the first one and then try to answer it. And then, Zeid, we're going to do this here jointly. So we're just going to both jump in from time to time. What is the average? So Simon Kang, thank you very much for your question. What is the average weight CBM requirement for fixed capacity? Sorry, now it started moving. Now let me take this one here. I wanted to. Sorry, it's moving around as we get the votes in. Simon Kang asks, what is the average weight CBM threshold for using international air freight versus Korea? And that's a very good question, a question that we're discussing with many of our customers. Where does it make sense to stick with a traditional courier, and where does it make sense basically to go and discuss it with a freight forwarder such as Flexport, that also offers additional capabilities like parcel injection. So basically, there will come for and it's really varies by your product and by your business, but and in what intervals you're sending your goods. But basically, what we always see is, and what we calculate in a conversation with our customers as we get to know them better, there's usually an inflection point, right? And at that inflection point, it below that inflection point, it actually doesn't make sense for you to go via a freight forwarder. But as you pass that inflection point, it can quickly become much more interesting versus a courier. I don't know, Zeid, if you want to add anything else to that.
Yeah, for sure. I think maybe the question was looking for some specific numbers. I mean, there's a cost benefit trade off to it, so I think the devil's in the details here. But just generally, what we tell clients is really anything less than 100 pounds is typically better shipped via courier. So that's about 45 kilos. I think from a CBM perspective, roughly 0.25 CBMs ish, something like that. I think if you have multiple parcels that are 45 kilos, there's always opportunity to consolidate those parcels on a pallet, right? But generally speaking, the rule of thumb is about 100 pounds.
All right. Going to the next question regarding fixed rates. Do you recommend use of fixed rates on key lanes? And if so, for what term?
I'm happy to take that one. I'll give it a stab. Yeah. Absolutely, yes. I think the best way to look at this is if you have consistency in volume on a specific port pair. Let's just use Hong Kong, Los Angeles, popular trade lane. If you have consistent volume on a specific trade lane, I think the benefits of a fixed rate are predictability and cost, but it also gives the forwarder an opportunity to really build a procurement program around that, which is going to translate into reliability. That's the most important thing, right? And really the way that we all sort of work on the forwarding side is that we're using our data to project out what we need to do from a procurement standpoint. And so understanding clients who have fixed rate agreements in place also gives us the ability to go back to back those deals on the market and secure the right type of capacity, whether it's a block space agreement or some sort of soft block. So generally speaking, I think the good rule of thumb is anything greater than 1,000 kilos a week on a specific port pair is always a good candidate for a fixed rate.
Thank you, Zeid. Going to the next question, Oliver Funds. Thank you for that one. He's asking, can you please speak again about estimated capacity increases between Asia and the US for 2024? How do you see capacity developing, and how will that affect rates? Can just start, and then Zeid, of course, happy for you to add. So basically, going back once more, that capacity situation, we what we do see is, right, the potential increase of China to US belly frequencies that will when it happens, have a strong impact on the capacity and obviously on the rate levels. And when we look at the overall storyline that we both tried to outline, is more predictability. So you're going to have more of a stabilization on rate levels. They will probably be below the 2024 peak levels that we have seen. That's certain. But still to be seen within Asia. Otherwise, besides if we put China on that side, what happens out of other markets such as Vietnam, right, which is not as strongly connected as China, to this stage, right? And the airline market in Southeast Asia is still growing, and much of that market still depends on interconnecting traffic versus the major hubs like Hong Kong and Shanghai. And that's where you might still, run the risk of higher rates when it comes to peaks like NPIs, new product introductions, and et cetera, out of countries like Vietnam or also Thailand.
Yeah, I'll just add one quick thing here. So, I mean, I think, typically speaking, kind of zooming out at a macro level, in a normal market environment pre-pandemic, about half of the global capacity is passenger and half of the global capacity is freighter. Not quite the case right now, right? But all signs point to the fact that that passenger capacity will come back into China. So I think there's a high likelihood here that if that happens, we will start to see a lot of the freighter capacity shift to some of these more underserved markets. And airlines are very good at revenue management, right? And they're going to put the capacity in the highest yielding markets. So I think there's a question here from Juan about niche markets that can arise in 2024. I'll sort of answer this one at the same time. I think there's lots of emerging markets such as Vietnam, such as India, that are very underserved with really limited direct capacity into North America and Europe. And so my humble prediction, for what it's worth, is that if we start to see some of that passenger capacity come back into China, we will start to see many of the freighter operators and even some of the forwarders who also operate freighters look to make some different decisions about how they design their networks and look to probably park some of that capacity in some of these underserved markets. Thomas, I don't know if there's anything you want to add to Juan's question about niche markets.
No. All right, then we're looking at the questions as they're coming in. What do you think are some of the Mei Chen? Thank you for your question. What do you think are some of the biggest challenges for cargo carriers such as Atlas, ATSG in the next 12 months? Happy to jump in on that one. So as we try to outline a bit this segment of carriers, right? They are very, very dependent on global trade and global trade only. So their business model very much depends on what flies from where, what's the production levels, and what's the demand side. Unlike the combination carriers, right? So the biggest challenges for them will basically all go around where do they deploy their freighters. How quick can they do that as the demand might shift short notice, right? The e-commerce trend that Zeid pointed out has, besides, of course, the positive momentum that comes with that, has also sometimes shown us some unexpectability in terms of quick demand rises as customers change their shopping behaviors in the past years. So that will be definitely a challenge. The other one is many of these traditional only cargo freighters still have also some older freighters in their fleet. And obviously, when we look at the still fuel price a bit decreasing, but still on high levels, it is economically not viable anymore to operate four engine aircrafts, right? And knowing that around 21% of the global 747 Boeing freighter fleet is in retirement age. Of course, that will be also a question in such a difficult market environment and not much on the supply side, new planes coming on the market as quickly as the old ones need to be phased out. That's another challenge on the operation side that these operators will also face. Zeid, I don't know if you want to add anything to that one.
Yeah, I think really, really well said. Maybe the one comment I will add is jet fuel. I think we talked about this a little bit before, but there's there's something called the crack spread, which really represents the spread of kerosene prices and jet fuel. And historically, they've been very similar, right? But over the last 2 years, because of the Ukrainian conflict and now the Israeli-Palestinian conflict, there's more of a demand for kerosene products, right, for military consumption, right? And so now that's created a spread between jet fuel and kerosene. And while it's closed in the last few months, I think last price I saw was 272. That's down from 352 from 3 or 4 months ago. That's still higher than where it was several years ago. So, I think the challenges that they will face, really all the freighter operators, is really from an economic standpoint. If jet fuel gets back to where it was at the beginning of this year, it becomes very prohibitive to operate those aircrafts. Generally speaking, it costs about $300,000 to run an aircraft, right? When you factor in pilot fee, pilot costs, crew, handling, landing rights, and then fuel, right? So, and obviously these are for-profit companies. So I think just from a cost economic standpoint, jet fuel is probably the big wild card here.
Thanks, Zeid. Looking at there's two more questions right now, at least unanswered. I think we still have a few minutes, so let's give it a shot. Nathan Lim, thank you for your question. You're asking what is the minimum kilo requirement for fixed capacity and block space agreements. Do you want me to? Okay.
Happy to take this one. Yeah, absolutely. So there's a couple ways to look at this, Nathan. I think in terms of just a lower deck position, right? You're talking 1,500-1,600 kilos a week. A main deck position is about 3 tons. CBM wise is maybe a little bit different. I think once you probably get over the, call it 3,000 to 5,000 kilos a week, there may be some upside to procuring fixed capacity as part of your overall portfolio, right? I don't think you want to put all your eggs in one basket, right? Because you do want to take advantage of the ebbs and flows in the spot market or with other rate agreements with other types of tools, right? Whether it's a monthly rate agreement or a quarterly rate agreement. So, I think that's the minimum. I would really look at markets where there's where demand is sort of outpacing supply. There's definitely some markets out there that have more supply than demand. Typically, the backhaul lanes, like Thomas touched on. So think of anything that's exporting from the United States. That's typically backhaul. No need to sign a fixed capacity deal out of that market. I think you can very confidently secure rates over a validity period and have a really, really reliable service there. But I think when you look at sort of Asia to North America, Asia to Europe, I think once you get to that probably 3 to 5 ton threshold on a weekly basis, it may make sense for you to start to look at some sort of block space agreement.
Yeah. Yeah, and maybe just one last element, Nathan. Also the fact, of course, like what's your SLAs towards the customer, right? That's also, of course, an important element, right? If you can manage, to not have as crazy SLAs that the e-commerce business has, and or on the inventory side can manage that in a different way, then of course that's another way to mitigate that risk or overcome the need for block space agreements. In addition to the very relevant points that they just mentioned in terms of regional variations and trade lanes. I think we're coming to the last question. If I see this correctly, one remains unanswered from Lucas Kim. Any big issues in 2024 near Dallas, Atlanta, or Chicago airports? I assume this question is on the operations side related. Zeid, do you want to take a jump on it, or?
Sure, I will take a stab at it. I think Dallas and Atlanta are typically pretty underserviced. Just in general, Chicago, tons of capacity going into that market just in general in terms of both freighter and passenger. I think what we'll start to see going into next year is a lot of that capacity into Dallas and Atlanta start to come back. Those are probably the markets that are still most impacted from some of the pandemic adjustments, in general. So I think we'll start to see a little bit more normalization there. They typically are a bit more expensive than traditional gateways like Chicago and Los Angeles. But the trade-off is really speed, because you can leverage Dallas and Atlanta to arrive your inventory to be closer to your clients. I think from just a pure handling standpoint, the market's fairly stable right now. There's not really any large backlogs forming in any of these terminals, so I don't suspect any big issues from a destination handling standpoint in any one of those markets.
Thank you, Zeid. All right, looking around the polls here, we have answered 7 questions. Looking around for one last, I think that's a wrap then. Thank you very much, everyone. It was a pleasure to have you. And please feel free to download the presentation, the deck. We will also share it via email, and be in touch with us if you want to discuss more air freight. We're looking forward to it.
Thanks so much, everybody. Take care.